Hello, welcome to episode 7 of Dhanmantra. Creation of wealth is a long journey full of uncertainties. Team Dhanmantra is determined to reduce the uncertainties and help you gain financial freedom. Today, we discuss about the real rate of return. We try to find out if a FD or your fixed deposit promises you 7%, then does it actually gives you 7%, or if there is any leakage in your ship? Let's discuss this further with our guests.
We have written down the real rate returns of 6 products. So first being fixed deposit, which is most popular among most of the investors. So when we talk about fixed deposits, the real return, as you can see, is only negative 0.2%, and that would be by factoring in 30% tax and 5% inflation. Here you can see the nominal rate of return is 6.8%, but that is not the actual rate of return that you are earning. You have to factor in tax, your tax bracket, and also your inflation. And when we do that, the real return decreases, and actually here you are losing money. You are not making money, you are losing money. So now moving ahead with rest of the products, the PPF, for example, if we take, the real rate of return is 3%, which is much more than the FD. It is positive 3%. Reason being, here the returns are not taxable. So whatever return you are earning, you can pocket that. You don't have to pay tax on it. Same is the case with Sukanya Samriddhi Yojana. Whereas for NCD, which invests in, if we invest in a secure NCD, AAA rated NCD, the return would be 1.3%.
Okay, so when we are calculating real rate of return, we need to understand we are basically looking at the purchasing power of that money, and what we really need is what are the leakages around them. So inflation is one leakage which will eat away your corpus. Taxation is one component which will then again deter your returns, and the cost of funding, if you are leveraging your purchase and the interest that you are paying on it, will take away the real rate of return that you could have gained without the cost of funding. So these are the 3 components that we need to discount for when we are looking for real rate of return.
Let's find out with our guests further that what is a nominal rate of return?
Nominal rate of return is the return which any asset gives at the end of the holding period. Now, when we talk about different assets, like an FD gives you 7% if it's compounding annually. So at the end of the period, you will get 7%. That is the gross return that you have gained.
Now, what is a post-tax real rate of return, or simply put, real rate of return?
Like we spoke, the nominal rate of return is the growth rate of your money, and the real rate of return is the growth in your purchasing power. The real rate of return comes after the impact of inflation, the taxation, the cost of funding. So the real rate of return is the actual money that you have earned with the investment that you have made.
Now, what exactly is inflation, and how does it impact our finances? Also, what happens when our returns are less than inflation?
In general terms, inflation is price rise of commodity. Technically, it is the rate at which the prices of goods and services in an economy is increasing over a period of time. So it basically decreases your purchasing power. It is denoted by percentage terms. To give an example, just suppose a family spends ₹1,00,000 over purchasing food items. So the next year, everything remaining the same, their income, their intake of food items, even if they remain same, just because the prices of items, food items have risen, they would not be able to buy the same quantity. So in 1 lakh rupees they will get lesser quantity of food. So that's how their purchasing power will get reduced, and that's how their lifestyle will get impacted.
Okay, basically in layman language I would say that you would die poor. And if in finance we talk about, basically you will be your wealth will deteriorate because it's not growing at inflation rate, and your expenses will shoot up because inflation is growing and your wealth is not. So the difference between the wealth and the expenses will gradually be so huge that you may not be even left with any wealth. In economics, what we say, it changes your consumption pattern. So when you don't have the money, you go for inferior goods. Maybe you'll go for McD coffee rather than Starbucks coffee. So when your money is not growing at par with inflation, your lifestyle, your consumption, your savings, your investments, everything will be, in the negative.
So now we know that inflation, taxes, and the cost of funding are the main causes of the leakage in our wealth creation journey. So, what should be the strategy to get the maximum benefit of our investments? Let's speak to our guests further. Inflation and taxes act as a big leakage in your portfolio. You might have accumulated a big corpus, but is it actually earning real returns for you? Now we have to aim for maximum real return. Some of the instruments like direct equity, shares, stocks, mutual funds, equity mutual funds specifically, these are the instruments which can give you much higher real rate of returns. Also in real estate, when you add cost of funding, which is your home loan, at around 9% and other charges like registration and all, it brings your real rate of return in real estate much low. So today is the time when you have to think outside the box, take some risk and create a healthy portfolio which can give you much higher real rate of return. Thank you.
Well, one should target at least 1% real return. If we look at the table, fixed deposit is a strict no, because there, instead of making money, you are losing your money. And products like Sukanya Samriddhi Yojana, PPF, they are still better off compared to others. And to get inflation adjusted returns, I mean, you can also think of investing in equity, which is much better in beating inflation and price rise, and that way you would not be able to miss out on any of your goals, and you would not have to compromise on your lifestyle.
So, analyze your investments today in terms of real rate of returns. In case you are getting anything less than 1% real rate of return, then we would suggest you to immediately consult your financial advisor and ask him to make the required changes in your investment portfolio. Team Dhanmantra wishing you a very happy investment journey. Thank you.